Hello, I'm Russ Mould, AJ Bell's Investment Director, and I'm here to talk to you today about the possible implications of the general election for the financial markets. Now, before we go any further, I should just pop in this little disclaimer here, because everything I'm going to talk about is based on past performance and general elections since the inception of the FTSE All-Share in 1962. And as we all know, past performance is no guarantee for the future. In addition, I should add straight away that the conclusions are all strictly drawn from the data and do not represent any political preference on my behalf or indeed that of AJ Bell. Now, most importantly, I'm going to look at what the ballots have meant for equities, bonds and sterling, because all three of these financial arenas are interconnected. So let's kick off with equities. So what I've done is I've gone back through the FTSE All-Share again, all the way back to its inception. Since then, there have been 13 general elections, 9 Prime Ministers, the first of whom was Harold Wilson, fellow Yorkshireman, Labour, 1964. So from Wilson onwards, I looked at all of the different elections and how the equity market has performed as benchmarked by the FTSE All-Share under each Prime Minister, and I've looked at whether party affiliation made any difference or not to how the market performed. Now, the conclusions are here, they're pretty clear. I'm going to talk you through them in chart format in a moment. First, the market seems to have a small preference for an incumbent victory when it comes to an election, perhaps a matter of better the devil that we know. Second, size of majority looks to make no difference whatsoever to how the market performs. That will offer succour to those who actually like the idea of a coalition government, or comfort to those who are frightened of one. And finally, probably perhaps the clearest data set, there does seem to be a political preference on the market's behalf in favour of a Conservative Prime Minister. So let's look at those things through the charts. And the first one here shows how the market performs when the government is the same after an election, that's the grey bar, and how the market performs when there's a change in government, that's the red bar. The first ones that you see on the left are after 1 year. The second set of bars, that's after the full term of the government. And as you can see, the market looks to do a little bit better in the first year when we actually have a change, but overall, over a full term, there looks to be a slight improvement in performance when there is a victory for the incumbent Prime Minister, the incumbent government. Secondly, coalitions, and this was perhaps the data set that surprised me the most. It doesn't seem to make an awful lot of difference. The bars here are the size of majority, the red line is the performance by administration, and as we can see, some of the smallest majorities actually throw up some of the best performance and some of the biggest majorities some of the worst. Now that's over 1 year, the first year of a government. This is over the full term of the government, and again, no great correlation. If anything, the smaller the majority, the better the performance. I can't really think of a great explanation for that. Now, in terms of Prime Minister, this is where perhaps a greater correlation appears. We've had those 9 Prime Ministers since 1964, and as you can see from this chart, the red bars, 4 of the worst 4 performances for the FTSE All-Share across the Prime Minister's full time in office, they all come from Labour. 4 of the best 5 performances all come under Prime Ministers from the Conservative Party, including Mr Cameron, who's obviously headed a coalition. So if there is the clear correlation anywhere in equities, it's probably that. Why that should be? Perhaps the Conservative Party is seen as the party of business, is seen as more pro-business, despite Labour's soft-touch regulatory plans of the early 21st century. So that's equities. Let's move on to bonds. Now, again, slightly shorter data set here. I can only get the numbers out of the Thomson data stream machine on the UK 10-year gilt bond index going back to the early 1980s. So I'm looking at 7 general elections and 6 Prime Ministers here since 1983. Now here, a change of government is slightly preferred. Again, size of majority looks to have made no difference. And the bond market, just like the stock market, looks to prefer a Conservative government. But again, I stress, this is just based on historic data. So again, bonds, change in government. Well, the grey bar, again, is when we get a change in government. And here there is marked out performance. Again, why that should be is difficult to divine. Perhaps they just think, oh, new broom, little bit of a change in policy may be the reason. But there's no clear explanation perhaps why that should be. Nevertheless, bonds seem to prefer a change. In terms of majority, very similar to equities, no great correlation between how the bond market performs and how the size of the government majority. And I should stress here that when we talk about bond performance, I'm basing it on the total return index for the UK 10-year gilt, and this is in nominal terms before inflation. So again, we've got the bars here, which are the size of the government majority, the line, which is the performance of the 10-year gilt total return index. No great correlation. Again, it's some of the smallest majorities, some of the best performance in their first year in office, and the same can be said over the full term of a government as well. Again, if there's a clearer correlation, it's how bonds perform by the colour of the Prime Minister's political affiliation. We've had 3 Conservative Prime Ministers, 2 Labour ones since 1983, and again here the worst performance in nominal terms has come under the 2 Labour Prime Ministers, Gordon Brown and Tony Blair, and the best performance has come under the Conservative Prime Ministers, Mrs Margaret Thatcher, Mr David Cameron and John Major, in that order. Again, that may be because the Conservatives are seen as perhaps, and I stress perhaps, the more fiscally responsible, and Labour perhaps seen as more fiscally expansive, but again, that's simply looking at how the data has fallen and attempting to interpret it. It certainly is no preference of mine necessarily. So we've done equities, we've done bonds. Now finally, let's move on to sterling. And there's certainly some concerns. Sterling has been quite weak recently, as people have looked at the possibility of how the market will accept a hung parliament, a coalition government coming out of the general election. So let's look at the pound. And again, we've got the full data set here going back to 1964 and all 13 elections, all 9 prime ministers. And here, an incumbent win is slightly preferred. Again, the size of majority makes no difference. And on this occasion, the party political preference of the Prime Minister doesn't seem to make a big difference either. You'll see, in fact, a very clear long-term trend, which is generally down in the British currency, regardless of who's in charge. So, an incumbent win is the red bar, a change in government is the grey bar, and as you can see, it's all pretty inconclusive. If anything, the most startling number is the big drop when we actually get a government change. That may seem to be the currency markets taking fright and facing uncertainty. In terms of sterling and the size of government majority, exactly as we've seen before, grey bar is the majority, red line is the performance of the currency, and in the first year of office, there's no correlation, and nor indeed is there particularly over the full year. If anything, there's a slight improvement here for the big majorities, as you can see right on the left-hand side of the chart, but it's all pretty inconclusive stuff. Now this is an intriguing one. We've seen clear correlations for bonds and equities in terms of a prime ministerial preference from the market, Conservative. Here, it makes absolutely no odds whatsoever. The 2 best performances for sterling have come under Labour, so have the 2 worst, with the Conservative Prime Ministers generally bracketed in the middle. What you will see from these 9 prime ministerial terms is that on 6 occasions sterling has gone down. And the long-term trend is very, very clearly down. Remember, sterling's gone from roughly $2.80 to around $1.50 since 1964. And I think, that's a matter of the UK's economic issues, interest rate movements, and a multiplicity of things, not just who's in charge at 10 Downing Street. But nevertheless, the long-term trend in sterling has been only one way, and it's been down. So the conclusions to bring all of this together: we've gone back across 13 general elections, 9 prime ministers for sterling and for equity, 7 general elections and 6 prime ministers for bonds. And certainly when it comes to a change in government, the stock market and the currency markets are happier when there's no change. Again, perhaps better the devil they know. Overall, size of majority does not seem to matter for equities, bonds or sterling. Again, encouraging those who would prefer a coalition government. And don't forget, the market's done very well under the Cameron-Clegg coalition. And certainly perhaps offering some comfort to those who are worried about the prospects of a hung parliament. But when it comes to a prime ministerial preference, equities and bonds, for whatever reason, clearly prefer the Conservative Party. Currencies, frankly, doesn't seem to make too much difference. The long-run trend in sterling is down. And again, this is if history is any guide. These are all based on historic numbers, no guarantees for the future. I would also add that these figures need to be kept in context. Remember, lots of other factors are at work here, both macro and micro. Now, from a stock market perspective, there's every possibility that certain sectors could become political footballs. Work from the French investment bank BNP Paribas last year flagged that roughly 5% could be knocked off FTSE 350 earnings by Labour Party policies. But since then, the Conservative Party has joined in, for example, with ideas with regard to things such as freezing rail fares for commuters. So there are lots of different sectors that could become political after the election, whether it's bookmaking, rail operators, bus operators, banks are obviously a hot topic, tobacco, a number of areas could be affected. But ultimately, let's face it, equities, and this is just referring to stocks, are at the moment a 30-year duration instrument. Think about it, with the average yield of around 3.5% on the FTSE All Share, just based on the dividends, if you were to view an equity as a bond, that's 30 years before you get all of your money back in the coupons or the dividends. So effectively an equity is a 30-year duration instrument. So a 5-year political term in office probably does need to be kept in context, even allowing for the fact that certain sectors may feel greater regulatory scrutiny, have to pay more tax, or both. So I think, again, we need to be aware of the fact that, yes, politics is going to be important in shaping sentiment, but long run, it's policies that affect profits and particularly cash flow that will matter. They could be reversed by the next administration anyway, and ultimately it's cash flow that's the arbiter of equity valuations and therefore long-term share price performance. An investor like Warren Buffett, for example, really wouldn't give two hoots what happens on Thursday, the 7th of May. He will continue to focus on company fundamentals, competitive position, pricing power, and valuation. So it's really down to you how you look to play any short-term volatility that comes through, or whether you simply choose to ignore it. And that will ultimately be down to your own individual strategy, time horizon, appetite for risk, and target return. Thank you very much for your time, and I look forward to seeing you soon.